A general analytical framework for the analysis of currencies and other commodities by Warren Mosler and Mathew Forstater. A note on pricing. The state is effectively the sole issuer of its currency. As Lerner and Colander put it, quote, "If anything is a natural monopoly, the money supply is." End quote. This means that the state is also the price setter for its currency when it issues and exchanges it for goods and services. It is also price setter of the interest owned rate for its currency. The latter is accomplished by managing the clearing balances and securities offered for sale. The corn farmer, however, is generally not the single supplier of corn, and therefore is not a price setter. In addition, as there is no central warehouse or its equivalent, the own rate for corn is 0% or negative, reflecting only a cost of storage and a cost of short selling. The model allows for two primary paths in the vertical component of a currency. The first is described above, and the second exists because it will be assumed that the state allows bank deposits to be used for payment of taxes. Therefore, banks are allowed to automatically function as intermediaries between the state and the private sector. This happens whenever a bank draft, check, is used for payment of taxes. The banking system is simultaneously obligated to accept funds from the state on terms dictated by the state to cover clearing balances debited when such checks clear. Initial demand for the currency, that which is necessary to pay taxes, originates with those with tax liabilities. When analyzing an economy, knowledge of the type of tax liabilities in force is fundamental to understanding its operation. For example, an asset tax, such as a property tax, will yield different results than a transaction tax, such as a sales tax, value-added tax, or income tax.